oftentimes, users of financial statements also do some analysis with the numbers. So instead of just looking at the numbers itself, of course, that has all the information there. But they often use some of the ratios, and throughout the semester, we'll be discussing some of the ratios, not just these two. There's also other ones to help you analyze the business. You can think of it as analyzing the business health position in terms of how risky it is, whether it's profitable, whether there's actually indicators that indicates that the business is doing pretty well, is prospering, based on some of the ratios. So they look at financial performance in different angles. All of them has a specific purpose. Okay, so accounting ratios, the purpose again, to measure business operations, the position of this business. And specifically in this chapter, we introduce two of the elementary ones, current ratio and debt ratio. In current ratio and debt ratio, in order to calculate these, you have to know whether an asset is considered current or long-term in order to determine this. Okay, decision makers often use different types of financial ratios in different angles, different aspects to evaluate business. So if the majority of the ratios they use to analyze all gives you a positive information, positive indicator, then that represents a company that, for example, creditors will be able to lend money to. Or you, as shareholders, investors, you want to invest your money to, provide capital to the business. Okay, oftentimes ratios are used specifically analyzing information that you see represented on financial statements.